Greetings, it is time for another CrashWatch video. I have not done one in several weeks, but the script is becoming more complicated because a number of unexpected events have transpired. So here we take our S&P 500, and everything was going down gently in terms of a managed correction. 2 steps down, 1 step up. 2 steps down, 1 step up. Well, it's obviously not ideal for the Federal Reserve to manage the market in this way. Arranging for a gradual downward motion that doesn't cause a panic and keeps the VIX index low is obviously less traumatic for the system. So far they had been successful in that. But now it seems like it stopped making new lows. So what is happening over here? It is actually making a high that is higher than any point since the last 6 months. So this leads us to think that there has been some fundamental shift in the markets and, more importantly, in the central bank monetary situation. So let's look at one of the biggest downward pressure points on the stock market. This is the Federal Reserve 30-year mortgage rate chart, and as I speak about in many videos, COVID-19 caused mortgage rates to get unusually low, and unfortunately that caused home prices to rise a lot, and too many Americans don't understand that this is a two-variable equation, so they thought that rates being low was the time to buy a house, which puts them in a very vulnerable situation from a negative equity point of view. The best thing to do is to buy when rates are high, and then when rates get low, refinance the previous amount of debt, a lower amount of debt, to a lower rate. That way you not only gain home equity, but your payments become lower too. To instead buy when rates are low and prices are high is the worst possible thing on both levels, because there is no room for your payments to get lower, but you could get into a negative equity situation. I described this in detail in this video up here in the upper right hand corner. But this area enclosed by this line and some floor, let's say 3%, but even a 4% floor, where you choose the floor is less important than to recognize the area enclosed by the floor and this line of mortgage rates is rising. And even though it went to 7% and has dipped down into the low 6% zone, that still means that this area is rising. If it is above 6% for another 1 month or 2 months, that means the area has risen by this amount. The size of this area is an approximation of how much downward pressure there is on the housing market in the US. Now, of course, housing prices going down is a big negative on consumer confidence, but the domino effect that has to fall is that it has to cause layoffs that causes job reductions at scale, which then creates a vicious cycle of further home prices falling, and then the stock market falls. So until the job market starts to weaken, homeowners can withstand a higher mortgage rate for some amount of time. Now, it's not fun to be at a situation where your home price is not rising for 10 to 12 years. You're at a flat home price for 12 years just to adjust for this higher mortgage rate, as well as the drainage of buyers from unusually expensive locations due to the work from home telework effect. But this is still a downward pressure factor for the stock market for the reason that I mentioned. But at the same time, let's look at the central bank monetary situation to see how a countering force has surprisingly appeared out of nowhere. This is the Yardeni report that longtime viewers know I do a monthly video about. And I'm going to do one for this month as well, but we're going to look at this in between because something extraordinary has occurred. Look at this Bank of Japan, as well as the People's Bank of China, the orange line, but the green line Bank of Japan is the stark one. In January, they printed another $500 billion, so they are resuming money printing again to a much greater amount than the US is deprinting. So when Japan is printing $500 billion a month again, that is much more than the $95 billion a month or less that the US is deprinting. And while this line has only been updated through December, the January line will indicate another 500 billion more at least. We don't have the China number yet, but assume it's similar to the prior month. There could be another 500 billion more at least, bringing us back up to here, which means more money printing, which is bullish for the stock market and cushions the housing market. Now, what we don't know is whether there is coordination between central banks. Japan can print a lot of money, which gives the US political cover to pretend that the US is deprinting because there is an irrational public demand to deprint, which I'm very critical of. But at least Japan is printing more than the US is deprinting. But in that scenario, the Federal Reserve and the Bank of Japan are coordinated, enabling the Bank of Japan to print more while the US Federal Reserve maintains the illusion of deprinting to satisfy US conservatives and a lot of PhD economists who think that printing money causes inflation when it clearly doesn't. What is more likely is that Japan has figured out many aspects of my atom thesis, which is that you can print money without commodities going up. Japan imports 100% of its oil, so it's very sensitive to oil prices, but oil prices are falling. As we see in my monthly videos, the commodity index is falling and oil is only $74 a barrel. And Japan has decided we're going to print as much as we can until oil rises, because we are just one country and oil is priced worldwide, and we can print an almost unlimited amount of money because oil prices still will not rise, so Japan will still not have high inflation. Almost no amount of money printing can make Japan have high inflation. And relative to their GDP, remember, Japan has done 4 times as much money printing as the United States. But since money printing is worldwide, what Japan prints mostly flows outside of Japan and flows into China and especially the United States, and perhaps creates an environment where the S&P 500 can rise again, because the world has flipped to net money printing again, as it should long term. But those of us who are waiting for a good entry point on the S&P 500, the chance of that happening now is a little bit less than before. You have to hope for a housing correction to overpower this Japanese money printing, or for the Japanese money printing to not hit U.S. shores soon enough before the United States is forced to take drastic reversal action in easing. So the very predictable stock market script that was unfolding now has become a much murkier picture, because Japan is printing money again, and a lot of it. Japan is not even that far from its pre-COVID level now. Even after this supposed tightening that they had done, they have already undone about half of that tightening, and they only need to do another trillion or so to get to an all-time high. And the world only needs to do another 5 to 6 trillion to get to its all-time high. Now, of course, it doesn't have to just get to its all-time high. It has to keep growing at 16 to 24% a year. So by 2024, it would have to be here to be fully satisfactory in terms of offsetting technological deflation. But that is a topic for other videos that I often speak about on this channel. So this was the CrashWatch video for February 5th, 2023. I hope you found this informative, and thank you very much for watching.